The market drops 2%, and your thumb finds the portfolio app before your brain finds a reason. Red numbers, a tight feeling in your chest, a voice suggesting you should sell something, anything, before it gets worse. But that feeling is not information, and the real reason you feel it is far stranger than fear. You are not reacting to your investments. You are reacting to a man. A very strange man that Benjamin Graham, the father of value investing, invented in 1949 to explain what the stock market really is. Once you meet him, you will never see a crash the same way again. And before this video ends, you will also hear how a $25 billion company came to be priced at 25 cents per share, while its business was doing better than ever. Hold onto that number. It is the entire lesson in one absurd figure. First, the man. In his book, The Intelligent Investor, Graham asks you to imagine you own a small share of a private business, worth about $1,000. You have a business partner. His name is Mr. Market, and he is remarkably obliging. Every single day, without fail, he knocks on your door and names a price. Some days he offers to buy your share at that price. Other days he offers to sell you more. Here is the catch, Mr. Market has wild mood swings. Some mornings his price is perfectly sensible, but often his emotions run the show. When he is euphoric, he names a ridiculous, inflated price, terrified of missing out on future gains. When he is despairing, he practically begs you to take his share for pennies, certain the world is ending. Same business, same day-to-day reality, completely different price. So ask yourself the question Graham asked. Would you let this man's daily mood decide what you believe your business is worth? Of course not. You would sell to him when his optimism made him overpay. You would buy from him when his panic made everything cheap. And the rest of the time, you would simply not answer the door. Graham's point is that if you own stocks, you already have this partner. The daily market price is not a verdict on your investments. It is one emotional man's mood, refreshed every few seconds on your screen. Jason Zweig, the financial journalist who wrote the modern commentary on Graham's book, pushed the image even further. Letting the market dictate your emotions, he argued, is like inviting an unstable stranger to tell you how to feel about your money 5 times a week. Millions of people accept that invitation every morning without noticing. Have you? Now about that 25 cents. Zweig documented the story of Inktomi, an internet search software company at the peak of the dot-com bubble. On March 17, 2000, its stock hit $231 and change, valuing the business at roughly $25 billion, about 250 times its annual revenues. The company had never earned a profit in its life. Mr. Market did not care. He was euphoric, and euphoric men do not read financial statements. Then his mood turned. By the end of September 2002, the same stock closed at 25 cents. The whole company was priced below $40 million. And here is the detail that should stop you cold. The business had not collapsed. Its revenues that year were around $113 million, higher than during the mania. The company was doing more actual business at 25 cents than it had at $231. Nothing changed except the mood. A few months later, Yahoo bought the entire company at $1.65 per share, nearly 7 times the bottom price. When Mr. Market despairs hard enough, rational buyers purchase whole companies out from under him. You might think you would have acted rationally through all of that. The data says otherwise. Zweig noted that in 1999, at the height of the euphoria, American employees were putting an average of 8.6% of their paychecks into retirement plans, buying at the most expensive prices in history. After the crash, when stocks were finally cheap, contributions fell. People rushed to buy high and quietly stopped buying low. That is Mr. Market running a nation's retirement accounts. So how does anyone resist him? In early 2009, in the darkest weeks of the financial crisis, one of Graham's own students showed you. Warren Buffett, who studied under Graham and calls the Mr. Market chapter one of the 2 most important things ever written about investing, published his annual letter to Berkshire Hathaway shareholders. In it, he made a startling admission. He was certain the economy would remain a wreck through 2009, and probably beyond. And then came the twist. He said that certainty told him nothing about whether stocks would rise or fall. The economy and the market are not the same thing. One is the business. The other is Mr. Market's mood about the business. Buffett had already been buying billions of dollars of investments through the panic, describing discounted stocks the way a shopper describes quality goods on sale. Months earlier, in a New York Times piece, he had compressed a lifetime of Graham's teaching into one line: be fearful when others are greedy, and greedy when others are fearful. And the verdict of history. The market hit bottom just weeks after that letter, and began one of the longest recoveries ever recorded. Graham understood panic from the inside, by the way. He invested through the crash that began in 1929, when the Dow fell from a record 381 all the way to 41, an 89% wipeout that nearly ruined him. His entire philosophy was forged in that fire. He concluded that the future cannot be predicted, only prepared for, and that preparation means never paying so much that Mr. Market's next tantrum can destroy you. He called that gap between price and value a margin of safety, and compared it to an engineer building a bridge to carry far more weight than it will ever face. Graham also taught that in the short run, the market behaves like a voting machine, counting popularity. In the long run, it behaves like a weighing machine, measuring real value. Panic is a voting phenomenon. Your job is to own things worth weighing. So what do you actually do with this today? One thing. Write down in one sentence why you own each investment you hold, the business reason, not the price. If a holding has no sentence, that is your homework. And if you invest a fixed amount automatically every month, notice what that system quietly does. It buys more shares when Mr. Market is depressed and fewer when he is euphoric, without asking your feelings for permission. Graham called it dollar-cost averaging. Your panic never gets a vote. The next time the market drops 2% and your thumb drifts toward the app, pause. Those red numbers are not a verdict. They are a knock at the door, one anxious man naming one mood-soaked price that you are free to ignore completely. You do not have to answer. If this video helped you see the man behind the price, share it with one person who checks their portfolio a little too often. A new Money Goggles video every week.